What do you wish that people on Wall Street understood about the crypto community that maybe they don't? Like what is the biggest disconnect that if that got solved, do you think a lot of this would kind of be easier?
That we're all druggies and dark web users, and there's still an enormous overhang of that perception in the community, from Wall Street's perspective. Yeah,
I say all the time. I say the currency of choice of every drug dealer, terrorist, money launderer in the world is
the U.S. dollar. You're right, 100% right.
Right.
Yeah.
And the other piece too, I think that Wall Street hasn't yet figured out is that there's a gentleman I know in the law enforcement community who said, look, from our perspective, we want every criminal to commit crimes with their hands on a keyboard.
Yeah.
Right.
Absolutely.
And so Bitcoin is a perfect example of what can occur when there is the, kind of the trackability, et cetera, of a currency.
It's more trackable than U.S. dollars for sure. And I believe FinCEN, the new head of FinCEN, just came out and said that, speaking at a Bitcoin conference or blockchain event in Chicago, if I'm not mistaken, and said exactly that. This is actually more traceable than the U.S. dollar now that they understand how to trace it.
It's amazing.
Yeah.
Okay, so let's fast forward. Wall Street bangs their head against the wall for a while, right? ICE kind of broke the seal. 10, 15, 20 years from now, what do quote unquote retail products in crypto look like once Wall Street gets involved? Like what do you think are the kind of most obvious things? Is it an ETF? Is it something else? What does that look like?
Well, I do think it's an ETF. And again, that's a double-edged sword. There are a lot of folks who are thinking that that's going to be a savior of the price correction that we've had in crypto. And I'm not so sure about that. I just saw Tour de Meester make reference to when the gold ETF was introduced. I think gold prices were up 350% within that period. And there's a big difference between what Wall Street was back then in 2004 and what Wall Street is today. There's so much more securities lending and rehypothecation of collateral than happened back then. And so the price action was more pure. And now I'm not so sure because of I was just talking over the weekend up at a Free State picnic with some folks who work in the Wall Street industry. We were just comparing notes, and we were talking about the securities lending market and how basically after the financial crisis, so many of the mutual funds, especially defined contribution plans like 401ks, turned off securities lending after the Northern Trust Fund had a problem with securities lending. And the entire defined contribution market went non-lending. A lot of the defined benefit market went non-lending as well. And everyone in the lending market thought, well, gosh, we're going to have a lot more, spreads are going to widen out. We're going to make more profit on what we're trading. And that we're going to have a lot more scarce assets, the sort of hard to borrow or special assets that are so meaty for Wall Street to intermediate because the profit margins are so wide. And guess what? Actually, the number of scarce and hard to borrow assets went down. Wow. You took out the entire defined contribution and defined benefit markets out of securities lending. How did that happen? The reason is because the accounting systems are manipulatable, shall we say? So I don't think that looking back at the 2004 gold example is actually, we're not going to see a replay of that because Wall Street has figured out how to rehypothecate assets. And that whole securities finance market has now consolidated. It used to be very disparate, but what was happening was the hedge funds were arbing the investment banks' funding desks themselves. So they'd go to the prime brokerage desk and put on one side of the trade and then take the other side of the trade with the repo desk at the same investment bank and collapse and collect a spread because the two parts of the investment bank weren't working with each other and they were pricing things differently. And now what's happened is that's all consolidated at all the investment banks into one department. And so all those different places where assets are lent and relent in any sort of rehypothecation, I'm using that term very broadly, but that's how Wall Street makes its money. And there's so much more of that than happened back 15, 20 years ago.